Welcome back to the LandCo podcast. In this episode, we'll be talking about the 3 most common down payment strategies when purchasing land. So, a few things about this episode. Most of our podcast episodes are part of kind of like an ongoing series, but from time to time, we like to throw one in as kind of advice or tips to kind of any land buyer, anyone from somebody who's new to it, who's looking to get into it, all the way up to, landowners who've been doing it for decades. So this episode will most likely benefit those people getting into it. Because we're going to talk about the 3 most common strategies when it comes to like down payments, putting money down on purchasing land. So I do want to say before we get into this, it's very rare that like someone's down payment falls exactly into one of these strategies. But when we talk to people about, how much do we want to put down and why, they most commonly start in one of these 3 buckets. And we can, go one way or the other a little bit when it comes to money, but so they often end up hybrids of these kind of buckets, but the conversations always start with these 3. Like 99% of the time they revolve around one of these strategies. So we thought it'd be valuable to kind of like let you guys know, like, hey, here's what most land investors do, because everybody wants to be in land investing, like everyone you talk to. And it's like, hey, I've dreamt about owning land. And sure, they could be just like saying that to like have conversation, but I feel like they're authentic and they're like, man, it'd be awesome to own land. But like 99% of the people that say that, they've never got past like looking at a property online. Like I'm not saying that they like would do it once they understand the first few basic steps, but it helps. Like it's not as scary as you may think to invest in land. So some of these podcasts will fall into what we may like eventually call like, tips or advice for land investors. But for now, we're trying to kind of clarify some things that people just either don't know or have some confusion about. So because I'm not an expert on buying houses. I've bought some personally, but I don't know. But I believe it to be different than people would do for houses. Like down payment strategies for land tend to be different discussions than I would imagine somebody has like when it's time to buy their main house. So I'm going to roll through 3 of these. The first is very easy and one that won't require much discussion. Because a lot of people, it's not even an option, but that is paid in full. Like no down payment, we're paying cash. And that may seem like a little scary to a lot of people. Don't worry about it, because if you can't do that, it's not a huge deal. But I do want to touch on that because it is a good strategy for people who simply want to move money. Like land, and depending on how you look at it, but land is no different than like a stock or another investment in, commercial real estate or a bond or whatever. Like it is an investment. And the difference that we've covered in many podcasts, but the difference is in our minds, like you get to enjoy your investment, which is a big deal. But at the end of the day, like it is a real estate investment. The paid in full strategy, is one that can be valuable for like somebody at the tail end of their career, somebody retired, somebody that's made, a decent amount of wealth early in their career. It is for people that have a lot of savings in place. But the benefit of those people doing that is like, it is as stress-free as you could possibly get. Like they're literally moving, they've got $1 million saved up in savings accounts. They're moving a portion of that, $500,000 from stocks into a piece of property. And they perform, very similarly. History would say that land has actually outperformed the stock market, but it's an asset. You get an annual, stocks will be dividends. The land's going to be cash rent or whatever it is. It's just a little more stable. So we see this most of the time in people towards the end of their career that maybe aren't quite as, they don't fully believe in the stock market. Like, listen, right now the stock market's great. I don't know that I've talked to one person that fully understands why or expects it to keep getting better. So like right now is a good example. People are taking money out of the stock market and moving it to land. It's a little unique now because we don't have much to sell them, but the theory holds true. Like it's moving money from one pocket to the other pocket. And it happens, I would say 15, 20% of our purchases are like that. And it could be a good strategy for people in that position of life. So we're moving on because that is not most of our clients. That is a small portion, but that is one that we see a lot. The next two are going to be ones that, are more relatable to most of our clients. They're similar, but they're approached in almost like opposite directions. So the second one is what we call like the monthly payment calculation. Like this is probably the closest to a house purchase as any of these three buckets kind of are. But it's like, okay, how much are we comfortable coming out of pocket with on an annual basis? Because one thing that differs from like mortgages for a house versus a farm, most farm mortgages, farm payments are annually. So they're once a year instead of monthly. But like you still kind of do the calculations, like how much am I cool with coming out of pocket with monthly to get to my end annual number? Like how much am I comfortable with? And this strategy does come with the most risk because it usually involves putting down like the minimum of what your bank will require, which is like, 20 to 30%, somewhere in that range. So you have, the leverage you have against that is lower than the other couple strategies. I don't say that in a bad way. You just kind of have to know that because this kind of bucket, this strategy is most often used by people like in the middle of their earning days. So, people that have a decent income coming in and they're like, hey, of this, 10, 15 grand a month, I am cool putting down the 20%, whatever the bank requires. Sometimes we'll have to save up for that to get it. But then, I'm cool coming up with $1,000 a month or $2,000 a month. Like each individual has their comfort zone. And then we back into a property that like will cost you that much. It's not quite that simple because there's a lot of variables for different property, but that's the idea. Like we figure out how much our client is comfortable coming out of pocket with, and we try to find something that matches that comfort level. So for example, the formula for this, well, I have this here, like if you're going to use this strategy, the two questions you ask yourself to start this are, how much money am I comfortable with putting down on a property? Again, I just said sometimes you don't have that, so you have to save up for a year or 2 years to get that. But like how much are you comfortable putting down? Because that will, affect how much total purchase power you have. So if you only have $5,000 to put down versus $100,000, you're talking about different properties. So how much money do I have to put down? Secondly, how much am I cool coming out of pocket with on like either a monthly or annual basis? So those two questions start the conversation. And then the formula that you get into like, okay, how much does this property cost me? It's going to be like specific to that property is simple. It's expenses and expenses. Well, so it's expenses minus income equals that net annual payment. Expenses and income are going to be different for every farm. But like in general, expenses are like your mortgage payment, your property taxes, and like, maintenance. If it's got a house, it's going to, have utilities. If it's got, wetlands, you have to pump, it's going to have utilities for pumps. Like there's a ton of different things each farm has that are unique to that farm, but in general, that's what you're going to be dealing with. On income, same thing, but for the most part, it's farm rent, the cash rent you get from the farmer that he pays you to farm it. Maybe CRP payments, which is similar. It's just letting it sit there. The government pays you. And then hunting, fishing leases, or if there's a lease on a house or whatever it is. But to get to back into an amount of how much that farm is going to cost somebody, you take the expenses, you deduct the income. What's left is what you'll have to come out of pocket with on an annual basis. So, for example, we'll kind of walk you through one here. Let's say a buyer is comfortable putting $50,000, okay? So and this number this formula will hold true no matter how much somebody has. But like, just for easy math, let's say somebody has 50 grand to put down and they're cool coming out of pocket with 10 grand a year annually. Okay. So what we do in this case, and we walk our clients through this. So the easiest way to back into like a range of properties that we'll look at this point are like, okay, what would happen if we bought a property, or what could we afford with those numbers? What could we afford if we bought something with zero income, which is typically like, you know, all water or all timber sort of property? And what could we afford if we bought something that's like, you know, we use all tillable sometimes as an example, but I think more accurately would be like, what's the highest amount of tillable that I want? Because if you're a deer hunter, like, you don't want 100% property, you want maybe up to 50 or 60%. So whatever that max is, that kind of, you know, that range is the properties that we'll look at, because you'll be surprised once we walk through this, you'll be surprised to see how big of a difference there is in carrying properties with no income versus carrying properties with income, with farmland or whatever it is, or CRP. So we have to make a few assumptions when we start this. So whatever location you're in, like if you're not in our location and using us, which you should be, but if you're not, let's say you're in Wisconsin, you sort of need to find a land broker if you're not familiar with the land investing game at all, to kind of help you make these assumptions. They're not like, again, we're just at a starting point. So these assumptions aren't backing into like an exact property. They're just helping us establish this range of properties. So we're going to assume to start 100% timber property with no income, property tax of $1,200 annually, so $100 a month. No ongoing maintenance costs. I know there's never going to be zero maintenance. Like even with timber properties, you're going to need to like get in there and clear your trails or whatever. But for timber property, they're pretty minimal. So like we're going to like ignore those tiny expenses for now. So under those circumstances, the formula will be like whatever comfortable annual payment you're cool with, which this guy's 10 grand, minus the property taxes, minus the maintenance expenses, do all that stuff. What you're left with is the annual mortgage payment. Okay. So like, let's go through some specific numbers that'll make more sense. For this buyer, we know his comfort zone is 10 grand. That's what he's cool with. I should back up. When I say the annual mortgage payment, like that is for this specific like case. That's what we would say, like, let's try to shoot for a mortgage in this amount, which would allow us to buy like, you know, this many acres or whatever, or this much money. So let's go through some specific numbers. So for this buyer, we know that he's cool with coming out of, he or she is cool with coming out of pocket of 10 grand. We plug that amount in. So 10 grand minus the property taxes of 1,200 minus the ongoing maintenance, which we have zero. It might be, depending on the property, it might be different. That, so 10,000 minus 1,200 minus zero is $8,800. So we backed into now like, okay, that's what sort of annual mortgage payment that this dude could afford. Okay. So it's $733 a month. So now we take that and we kind of run it against the current climate of like, you know, loans on property, and those change depending on when you're listening to this. But like right now, let's say it's around 4% if you do the 30-year amortization schedule. So, you know, banks aren't financing for 30 years, but you'll do like a 4 or 5 year ARM on that schedule. So the numbers will stay the same. So if you plug in a loan of 150 grand with those terms, it comes out to an annual payment of $8,600. Okay. It's not exact, but we're close. You see how we do this. So 150 grand is the loan he would get. He has 50 grand to put down. So if that buyer is looking at the beginning of that range, all timber, 150 mortgage, 50 down, that's a $200,000 property. Okay. So with his comfort level, that's where the beginning of his range, 200 grand. Okay. Now we do the same exercise for a property that has income. So again, this doesn't mean that like this buyer would be comfortable with all tillable. We just do that to get like a range of properties to look at. So if we assume a property with 100% tillable, and again, we're making more assumptions here, with $9,000 of annual income. The reason we're using $9,000 is because around here, like you get like a 3% return on properties. That's pretty normal. So the reason we do that is I am like assuming that if the low amount of this guy's buying power, $200,000, I'm going to make that jump to $300,000. I don't know if I know this to be, I know the end of this exercise now, but when I did this, I didn't. So I made that jump assuming like, well, let's just pretend $300,000 is the high end of this buyer's kind of buying power or comfort level. So I use 3% return, which is $9,000. Property taxes are a little more expensive on income properties here. So I bumped that to $200 a month. And again, no ongoing maintenance. So if we do that, we do the same exact, the same exact formula. So what we do is I want to make sure I'm not missing this. He's still putting $50,000 down. So that would result in a $250,000 mortgage or $14,400 a year. Property tax was $2,400 for a total of $16,800. That's the total expenses. The income is $9,000. Again, we're just making assumptions. So you take that $16,800 of expenses minus $9,000 of income, and it's $7,800 out of pocket annually. So it's like, well, we're at the low end. We're still not at the buyer's. Like, if it was close, we kind of end the exercise. We're still only, 78% of the way there. So it reveals that $300,000, if it's all tillable, is well within this guy's buying power. Not only well within it, it's like not even at the high end. So what we do is we keep bumping that until we get to like where this buyer's comfort level is. So let's say we bump that another $50,000, okay? So now the income would be at 3%. The income is $10,500. Still putting $50,000 down. So a $250,000 or a $300,000 mortgage now at the same thing. Your 4% is $17,200 a year. And you can get these with your banker. You can go to Google and plug them in on a mortgage calculator. We're not looking to get exact. We're looking to get close to identify a range of properties that we should look at, or at least start running numbers on. So $300,000 mortgage, $17,200 a year, property tax $2,400. That's a total of $19,600 of expenses minus the income of $10,500 equals $9,100 annually out of pocket expenses. So $350,000, and we're still not to the $10,000 comfort range for this buyer. We're at $9,100, but that tells us that $350,000 worth of 100% income producing property is within this buyer's comfort zone, and leaves a little wiggle room. We could keep going and dial that in like exactly, but for the most part, we're where we need to be. So we have that conversation like, okay, if you want to come out of pocket with $10,000 a year, our range is from $200,000 with no income all the way up to $350,000 with all income. So any property in the middle there, it could be $275,000 with half tillable. Cool, that's within our range. If it's $300,000 with no income, well, we can't afford that. Like, that's not outside of the comfort level. We need to get income if it goes above $200,000, and the sliding scale goes all the way up to $350,000, maybe a little higher than that for all income. So that's just kind of like, and you could back into that in like more general terms, ballparking, but that exercise gets you fairly close. And again, that is for buyers that want to back into a certain payment that they are comfortable with. So again, a lot of times these are hybrids, and it's like, well, that's where it starts. That's what I want to do. I want 10,000, out of pocket max. And then we find a property and it's like the math, what we need to buy it for, the math is going to come in at $12,000 annually. That's more than you want. you want to make a run at it or not. And then you kind of make those decisions on the fly a little bit, but at least you have a base to go off of. You know, if it's like, hey man, this property's only cost us $5,000 and we love it, like it's a no-brainer. Then you have a little more wiggle room to maybe even, you know, overreach a little bit for a property that you really, really want. So it's an exercise. We probably do this with clients more so than either of these other two, the methods. So that is it. That's the second one. The last one is similar, but you start exactly backwards, which sounds a little weird, but I'll walk you through it. The last method, and this is one that like, it's become our favorite. This is what like I use personally now when I buy property. I try to get to these numbers. You run the same formula as you did before to get to the exact number of income. So essentially, the question becomes, how much do I need to put down on that property to never make a payment on it again? So like, I want to put down enough money and forget about it. And every year when I get the income, I'm going to take that income and I'm going to give it to my banker and be done with it. So like, it carries less stress. There's a little stress because it's not like you're paying cash for the whole thing. So if the income goes down or like, you know, there are reasons where you would maybe have to come out of pocket, but in general, the strategy is like, I don't want to have to bring any money to the table. I want to buy a property with whatever money I have. I want to buy a property that will carry itself, essentially. And this has actually become a lot of, like, I didn't come up with this. A lot of our buyers did, and not like, they didn't pull together and be like, let's do this. It just seemed to be a common kind of like strategy among some of our investors that like I learned as much from them as they learned from me. And it became kind of a common theme among a lot of these guys. And I'm like, man, it makes a lot of sense. Especially with the interest rates so low, like these numbers would be way different if in 10 years it's, you know, 12% to get a loan or whatever it is. So not only do I like the theory of it, it's easier now, you know, with interest rates at 3 to 4, whatever it is, it's easier now than it, you know, has been in years past. So walking through that, I'm sure you get that concept, but just kind of walking you through that, how we do it is, we don't kind of, the numbers will change based on how much tillable, but we like to get like, when we do this, it's more of like, here's the target property. Most of these buyers know exactly what they want. Like, we want to enjoy the money we have, and so here's ideally what we'd get. Okay, so like, let's say you look at let's say you have $100,000 to put down, just for easy math. Again, every situation is different. Let's say you've got $100,000. You just, again, got to make a few assumptions about this. So let's start in the middle. You can do it anyways, but let's say you find a property that's 50% tillable, okay? If that property is 200 grand, let's say, like, is my 100 grand enough to carry it? These numbers will change. This is kind of like, hey, here's your starting point. And then we could go either way a little bit. And if you need to come up with more money, then we'd have that discussion. If you don't need all of it, cool. But let's just say you find a property that's either listed or it's going to cost you 200 grand to buy, okay? Let's assume it's a 2.5% return, which is, you know, fairly common for, again, this is where you have to kind of work with your local broker to be like, what's common for a property like this? But let's say it's 5 grand. That's probably a touch high. 2% is probably more accurate, but for like easy math, let's use 5 grand on income. A mortgage on $100,000, because remember, if it's a $200,000 property and we have $100,000 to put down, a mortgage on $100,000 about $57.50 a year. Say taxes are, you know, $100 a month. It might be a little more than that, but for easy math, that's $1,200. So you're going through expenses, which is $69.50, which is your mortgage payment, $57.50 plus the $1,200 is roughly $69.50, minus income, which in this case is 5 grand. That scenario would result in just shy of a $2,000 out-of-pocket expense, $1,950. So it's like, okay, well, there you go. That is the ceiling. If you're looking at a property that's about half tillable, if there's more tillable, that ceiling is going to bump a little more. If there's less, it's going to go down. But in a property that's about 50%, that buyer can afford roughly $200,000 worth of property, where he would say, here's my down payment. For the most part, like, unless something goes kind of weird, I don't want to come out of pocket with money. So when I get my either ag payment or CRP payment, I'm taking that, giving it to my bank, and I'm home free. Like, I don't have to move money around or I don't have to make any mortgage payments. That's what, and again, it's a great strategy because it's cool to only have one payment a year. Like a house, you have to, you make payments monthly, which is fine. It's cool to only have one payment a year on farms because you can kind of line it up with your, like when you get your cash rent. But it also sucks, like when it's due, if those payments aren't close and you have to come out of pocket, like the example before where somebody's cool coming out of pocket with $1,000 a month, like very rarely does that buyer like put $1,000 a month away into like, some account. It's like, hey, your mortgage is due, you owe me 10 grand. It's like, that's the downside of that. So under this last strategy to where it's like, I don't want to have to come out of pocket with anything. You don't like you, in any other circumstance, you're like, man, that payment's due in a month or 2 months or whatever. It's kind of like in the back of your head. In this scenario, like it is out of sight, out of mind. You just don't need to worry about it. And if there's a weird year where it's like, hey, we didn't get our 5 grand, we only got 4 grand. Well, okay, I need a couple grand. It's not as bad as like, hey, your $20,000 mortgage payment is due. So it is one that has become more popular among buyers and very common for like a lot of the investors that we trust a lot. So that is it. That is the 3 buckets. And again, the first one, paying for something in cash, is pretty, self-explanatory. The other 2, that's where they start. It's very rare that like they end up exactly, because we're dealing with farms that are all different. It's not like buying some Google stock where you can say, I want this much, worth of stock. You pick one of these strategies that you're comfortable with, and then you run the numbers on a specific farm. And sure, if you can get someone to accept an offer on like exactly the number that you need, cool, you're going to back into like a precise number, but that's very rarely the case. So like, for example, on this last one, like let's say $200,000 would do it, and he's like, sorry, 210 is as low as I'll go. Well, like, then you kind of have a decision to make. So like, do I buy that knowing that like I'll have to come out of pocket a little bit each year? Or do you say, nope, 200 grand is my number? Or do you say, I'll do it and let's close in 6 months to give me some time to save up some more money? Like there's a lot of variables that you come into when you line them up with a specific property. But the thought process that our buyers go through when they decide, like when they think through, like how much am I going to put down and how's that work? How's that align with what I want to buy? They almost always start with one of those 3 kind of buckets. So just wanted to walk you through those. If you're new to land investing, I hope that kind of helps, give you like an idea of different strategies different buyers have. No one is right or wrong. They're probably more commonly used by people in different stages of life. So like the paying cash is older people who have money in their accounts or someone that's accumulated wealth. The middle strategy is one that's like where the buyer is trying to back into a certain number that they're comfortable with out of pocket. That's usually buyers who are in the middle of their like earning days, their career, where they can budget in, numbers for those. The pay for itself strategy is honestly probably used more by like land investors that, not even land investors, but like people who consider their land purchase, they may use it to hunt or fish or, whatever it is, but they're thinking about the purchase in terms of as an investment, not just like, I'm going to buy land to go hunt it. So it's used more by like people who are considering it more like a stock or an investment than the middle group. But that's it. And a lot of times that last, the pay for itself strategy, it's used by people who don't care too much about what some of the benefits of properties come with like, I use that for waterfowl properties and fishing because I like to do that. But I've also bought a property where it's like, I don't care about the fishing. So I'll give up that right and only duck hunt it. So like to get to the number that I need to pay for itself, sometimes you have to lease some stuff out. And some of our buyers go all the way till it's like, hey, let's buy that and we'll lease everything out. So all I'm doing is buying a property that I'll have paid off in however many years, 15 or 30 years. And I don't need to use it because I don't want to use it. I just have some money to invest in a property. So that's it. Those are the 3 most common down payment strategies that we see. And I hope that, if you're new into land investing, I hope that helps. And well, our plan is going to keep coming up with some of these episodes that are, that hopefully bring value to people that are looking to get into this land investing market or that own property that are looking to, maximize their investment. So we appreciate you guys listening. And if you want to listen to more of them, hop on our website, landco.com, or follow us, subscribe on Apple Podcasts. All of our stuff is on there as well. And we'll hope to continue bringing you value. So thanks for listening.